Hello, everyone, and welcome to the ETFatlas podcast. My name is Jack Lampart. ETFatlas is a comprehensive database of more than 11,000 ETFs from the United States, Canada, and Europe, including many trend-following ETFs that we'll be talking about today. It's a real pleasure to welcome our special guest today, Jerry Parker. Jerry, thank you very much for joining us. Could you start by introducing yourself and sharing your journey from accounting to becoming one of the most successful trend followers in the world?
Well, Jack, thanks for having me. It's good to be here. That's a really large question. Accounting first. And that was something I wanted to do. And then once I started doing it, I wanted to stop doing that and do something more fun and exciting. And I probably read books and magazines and watched TV a lot to uncover this love of trading that I had. And so I was reading books about trend following when I saw the ad in the Wall Street Journal in 1983. So that's a long time ago. From Richard Dennis, and I thought this was a really good idea for me to be sort of a technical trader, a trend follower. I learned a little bit about trend following from newsletters, books. Martin Zweig was a famous trader back then, money manager, and he was teaching me a little bit about trend in his newsletters and on TV on Wall Street Week. And I liked the idea of charts and the subjectivity of trend following and rules-based trading. So then I was lucky enough to see that ad in the Wall Street Journal, and I applied for that job to go to Chicago and learn how to trade futures with Richard Dennis and Bill Eckhart. And it became the Turtle program, and I actually got an interview, went to Chicago, got the job, went back, and we had a 2-week Turtle course in December of 83, and started trading probably like January the 2nd, 1984, with $1 million, with the idea that we were supposed to follow the rules. If you followed the rules and lost money, that was okay. It was okay for a while. Can't continue to lose money. But if you made money and you didn't follow the rules, well, that would be unacceptable. So that was one of the core tenets that we had of you must follow the rules. You must have faith in your strategy and your system that's been back tested. And we were totally prepared with everything we needed to become good traders. And we did. Over a period of 4 years, we were probably the turtles in that room probably averaged about 150%, 200% a year, trading with really large leverage and really big losses and drawdowns at sometimes. But that was the strategy. That's what Rich wanted us to do. And that's what we did. And it was a great program, a great idea, great adventure for all of us. One of the most important things to remember about that, it was a pretend environment. It was people who were giving you great rules. They were your clients. They thought the rules were fantastic. If you lost money, that's okay. That sort of client kind of doesn't really exist in real life. And being there with them, and not just having the written rules and the training, but being there on a daily basis with the encouragement and the positive feedback and assessment of your trading style on a daily basis was pretty important for success.
All right. So maybe let's stop for a while in 1983, because I think that the picture you just described, it sounds like the most extraordinary financial experiments. I mean the turtle trading experiment. But for those unfamiliar, for our listeners, the Richard Dennis and Bill Eckhart, they had a nature versus nurture bet and recruited, correct me if I'm wrong, 14 novices via Wall Street Journal, as you said. And I think which feels like the script for a good Hollywood film, by the way. I wanted to ask you, walk us through those 2 weeks of training with Richard Dennis and Bill Eckhart. I mean, what were the key concepts they emphasized? And was there maybe one thing which surprised you most about their approach?
Their approach, like I said, was based upon computer research, back testing, It was rules-based. There was a lot of things that surprised me that they would even have the course and even do this project. Why would they even do this? They were super genius people, really smart. That's probably the most impressive thing about it. That the thing that people need to realize that these were really genius people who had devised this strategy and taught it to us. They emphasized the idea that it was hard to do, psychologically hard to do, and to maintain your discipline and continue to take losses, and to trade a methodology that had 60% losing trades and very, very infrequent large winners. That formula of taking small losses, lots of losses, and letting profits run and having only a few trades be responsible for all your years of the profit in an entire year. And then the idea that you had to let the profit run and not try to get out too quickly, and have a lot of open profit at risk where you could give it back. They would say that small profits can turn, large profits can turn into losses. Large profits can turn into small profits. And so theoretically, when you're in the class, that, okay, this is great, makes sense, trading's hard, not a lot of people can do it. That's probably why it's going to continue to work. But then when you try to do it, hey, it's really hard. I'm having a hard time doing this and enjoying this. And I think another key component that is missed by so many people is that it wasn't just them teaching us what's going to work now. It's they were trying to lay the groundwork for equipping us for the rest of our life on how to evolve and change as the markets changed. And these principles that they laid out were principles that we should be able to use forever. And but the specific system and the parameters would probably change over our career, which is definitely true.
All right, we'll go into details of trend following in a while. I wanted to ask you, because there are claims about your profits during the turtle period, and some sources, they indicate that the turtles, they made over $175 million, around $200 million in 5 years. And in one of the sources, I read that you personally made like over 30 million by 1993. Are you able maybe to clarify your actual performance during the turtle period? I mean, this 5 years, 83, 88, and how did this maybe shape your understanding of markets?
Well, it was 4 years, 84 through 87. So,
all right.
And then I don't know the numbers like that. I do know the percentages, and percentages were 150 to 200% a year. And, some people had difficulty embracing that sort of leverage. And so some people made more and some people made a lot less, strictly because they were just uncomfortable being following the rules as relates, or the maximum rules where, they would say, okay, you can have a position on this large. Some people took the assumption that they would not want to trade very large. So maybe they were making 50% and the drawdowns were very large. I know there was one day where I lost 50% in one day, but we were up 200%. So, we had that open profit to lose. And that's the core component of trend following, is to treat the profits and losses differently. The losses are small as it relates to your capital. But in a profit, in order to make the big profits, in order to make 200%, you must have a trailing stop that's not too close. And you'd have to use a lot of leverage, and you're going to have big fluctuations in your open trade, but not in your capital. And so I think that was something, even though it makes sense and it is what happens, it is difficult for people to embrace.
And going back to that experiment, do you know what happened to your fellow turtle traders? How many maybe continued with trend following, and what can you tell us about their current endeavors maybe?
One of the things about, another thing that we were told in the turtle class was other people and clients in particular will be an impediment to successful trading. Like they will not enjoy your style and your strategy. And so beware of the clients trying to convince you that your strategy is not good, and complaining. And so a lot of turtles probably just took that to heart and didn't want to start a business. And so probably the majority just traded their own money, or traded internally for companies that understood trend following, but maybe less than half went out on their own, started their own company, and there was probably 10 people who had substantial, nice trading firms, CTAs, over time, and then it had really long, decent long track records. And there's a few still doing it today, Chesapeake, EMC, but I think that's probably the extent of it. There's not too many other people still trading. I think one of the things about the turtles was to sort of not desire to go out and have a big business and to keep it small and keep it simple and trade your own money, which is what Rich did mostly, compared to the European traders coming out of AHL in Man and like Aspect and Winton and some of the others who, coming from a more corporate background, were more well-versed in starting businesses and having organizations that raised lots of money.
And what's your understanding of maybe what Richard Dennis and Bill Eckhart are doing today? I mean, do you maybe still maintain contact each other?
I haven't maintained contact with Rich and Bill in quite a while. Probably the last time I saw them was about 10 years ago in Chicago at a Turtle reunion. We've had a couple of the Turtle reunions in Chicago. And I know Bill is probably still, I think he's still trading or just stopped trading. Recently, he built up a nice business for over many years. And Rich hasn't traded in a while for, with public access that I know about. But I'm sure he's always trading and trading his own money. Those guys love to trade. They just love the game and the intellectual pursuit of trading. I think that they came to feel like over the past years that I left the Turtle program as a diehard trend follower. And I think that what most people took out of the Turtle years, the Turtles, and was more of what Rich and Bill embodied, which was less sort of wanting to be a trend follower for life and more concentrating on being a systematic trader. So wherever the data and the research took you, which may not be long-term trend following, was more the strategy and the idea that the others had, where I sort of went into the program loving trend following, come out of the program loving trend following, and then continued that pursuit. But I think most of the other Turtles and Rich and Bill probably were more willing than I was to deviate from trend following and use the back testing and the research to come up with other strategies. Possibly. It's kind of just my guess, actually.
For someone new to investing and trend following, how would you explain what trend following is and why it works?
Well, it's simply really, it can be many things to different people, your own specific ways of creating your system and using technical ideas like moving averages and breakouts. But it's really just taking small losses, keeping the losses small, and letting the profits run. And the more you can let the profits run, the better. And really what that means is just being more willing to suffer through drawdowns and volatility with open profits. And doing a back test, you can kind of see what parameters work and what sort of look back periods you need. Over the Turtles traded fairly short-term trends, but then as we went out into the real world and started our own business, we had to become longer term. So I think most CTAs now hold their positions for 6 months to a year, possibly. And so it's much longer term trend following than what the Turtles experienced. Certainly part of trend following for most people is trading lots of different markets, currencies, commodities, stocks, and bonds, long and short. It doesn't always have to be that way, and it isn't always that way. You can still use a trend following system on stocks only, for instance, or crypto only, I suppose, and not do short trades if you don't want to. But it is a type of strategy that does only have around 40% winning trades. The winning trades are that are responsible for the profits can be just a handful of trades every year. So the profits are infrequent. And that particular strategy really needs some help. And one of the ways you can help it is by trading lots of different markets. So that's what we do at Chesapeake. Lots of stocks, lots of bond futures and bond ETFs, and then as many commodities as we can find. They're really great markets to trade. It's where sort of trend following and CTAs started in the commodity markets. And then interest rates. The last great trend for the CTAs was short bonds in 2022. That was a really big trend. Looking at price data only possibly is another thing, only looking at the trends. Certainly trading methodologies and systems and parameters that you've back tested is another big part of being a trend follower. Doing the hard thing, doing the right thing, suffering. These are all ideas that I got from Richard Dennis, and that's really the key to
No
trend
pain, no
following, and
gain.
no pain, no gain. And I think you asked, why do I think trend following will continue to work? Or if I do think it, I think it will work to the degree that it's hard for people to do. It's psychologically difficult. No one really likes to give back profit. But I think that's the key to trading. And the computer back test and research will say, more than likely for most traders, you're not giving back enough profit. You're not willing to risk enough profit. No one likes to take small losses. People like to take small profits. It makes you feel better. It makes you think that you're a better person and rewards you. What you need to is try to fight your instinct and fight the human tendency to want positive feedback, but be willing to be in the minority and do things that other people don't want to do.
And what are the biggest misconceptions about trend following in your view, especially maybe from those used to buy and hold investing?
Sometimes I think it's broken because it has a tendency to go through periods where it doesn't work very well. You can tell when it's broken. You can tell when it's going to start working again. That's not true. I think the biggest is the biggest problem with most traders, even those who try trend following and who say that they're trend followers. They say they're trend followers. They say they are trend following. The biggest problem that they have is hanging in there with a profit. They want to get out too quickly. They want to come up with reasons to get out. If the trend hasn't changed, you shouldn't get out. And they also say it's risky. The risk is the losing trade. Taking a small hit to your capital, losing 0.5%, 1%. And it's not to be dismissed because it's a low win rate system. And if you're down 20%, it's probably just a lot of small losses. So it is a problem to take these small losses because there can be too many of them over a short period of time. But to have a trade on and to have a big profit in it and to give back a material amount, 25% or 50% of that profit, that's not risk, that's not loss. So it's really imperative that traders understand that they need to and how they can separate those two ideas of taking small losses and letting the profits run. And really, it is just that simple. Even the most experienced, and I would say not even, but the most experienced traders with the most amount of money under management who claim to be trend followers don't let the profits run. They try to reduce the trades, get out of the trade before the trade has turned around and before the trend has ended. And so they'll write into their code and their programs, get out of the trade if it's too volatile or if it's more correlated than it used to be to other markets. So it's really a plague. And really, there's not that many people, in my opinion, who are really practicing what trend following was designed to be, which is take small losses and let profits run.
Before diving deeper, could you explain for the listeners what managed futures and CTA mean? And what is maybe the relationship to trend following? Because I see quite often, especially among beginners, that these terms are not well understood.
Well, yeah, they're kind of the same. Managed futures has a lot of good things going for it and some negative things. It is a well-known term, and it is, I think managed futures CTAs have come up with a strategy to raise money by um, impressing upon people the benefits that adding trend following and CTAs to the portfolio. So allocate a small percentage of the portfolio to CTAs, and it can help during drawdowns of the stock market and bonds. So in America, at least, everyone is obsessed with the S&P and maybe a few bonds as well. And so everything revolves around that. So CTAs are this group of people who define themselves primarily as how can I help your stock portfolio, which is a little sad because I think over the long term, trend following, diversified trend following can be just as good or better performer than the stock market. I like to use the term classic trend following or classic CTAs, which is more of an emphasis on trend following and less on managed futures, which most managed future CTAs have a little bit of trend following, or maybe there could be some have almost no trend following. But even if they have 50% or 70% trend following, there's going to be a heavy dose of other strategies like mean reversion, pattern recognition, carry trades. So even CTAs are a little bit different, strange, unfortunate, in my opinion, to be one of the only hedge fund categories that doesn't feel comfortable with a product that is pure trend, for instance. This is what we do, so what we're good at. They want to create some diversification within inside their own program, not relying totally upon the allocator to build the program, build the portfolio with stocks, bonds, and different strategies of trend following. They want to take the trend following and change it a bit, make it more palatable, make it less hard to do with these methods that I mentioned before. Take profits before the trend turns around. Pay attention to the Sharpe ratio, which is sort of anti-trend following. The Sharpe ratio doesn't really fit with trend following because it's not a normal distribution of trades. So I think that most people like the term managed futures, but I like CTA because it's from the 70s and it really gives more of an emphasis on trend and diversification of what CTAs used to be. One of my main goals is to bring back classic trend following and make people see the virtues of classic trend and following trends and taking small losses and not watering it down with other strategies inside it and making it and not reducing the positions when the trends are still going up, which is what happens in managed futures.
How has your approach to trend following evolved since the turtle days from the 80s? What new markets do you trade today, for example?
That's a good question. And a lot of it does revolve around the new markets, because that was one of the things that was impressed upon us early on, trade more markets. Trading more markets is fantastic. It's going to make things better. There's no problem with trading more markets. There can be problems with more parameters, more rules. It reduces your sample size and increases the optimization. But with a more simple classic trend system of an entry, an exit, and a stop loss, adding more and more markets makes everything better without reducing the robustness and increasing the optimization of the systematic approach. And so from day one, I was very, very interested in adding more markets. So in the beginning, in 1984, we traded 20 markets. Now we're up to 400 or 500 markets. And we trade every commodity possible. Well, with nothing in China, but I know there's some CTAs who even trade the China commodities. Great for them. That's fantastic. I'm jealous. I wish I could trade those Chinese commodity markets. All the currencies and the cross rates, we trade them. So 50 currencies. We trade all the bond futures around the world: Canada, US, Asia, Europe, Africa. Bond ETFs that are not represented in the futures markets, like corporate bonds, TIPS, munis, high yield, emerging markets, mortgage backs, you name it. We're on a massive search all the time for more and more markets. And then I thought early on in the 90s, I guess, that really the best meaningful way to dramatically expand the portfolio is to trade single stocks. So we trade hundreds of stocks, long and short. So not just an index. The managed futures CTAs are pretty much limiting themselves to indices, stock indexes, because they don't want to run afoul of the clients. The clients don't want the CTAs dabbling in stocks. You're fine. Just trade these futures markets. We don't really care about you anyways too much. You're only a 5% allocation. And we only kind of want you in the portfolio because you may help us during a stock sell-off. And we already have stocks, but it's better for the CTA. It's better for the CTA's performance and their track record and their own profitability to add these stocks. And trading the stocks are much better than trading indices. You could have some longs on, some shorts on. So often the indexes are all of them around the world are all long or they're all short, and you don't get that diversification that you get trading the single stocks. No CTA would trade the dollar index only or a commodity index. Oh no, they would trade all the currencies and all the commodities. So why do they trade the indices only? You'll have to ask them, but they should not do that. We should trade these wonderful stocks that have great trends, and their clients like the stocks more than anything, and they really can understand how adding stocks and adding will give you lots more diversification in that sector. We need to do the best we can in stocks because sometimes, recently especially, stocks have been the best performer and the best trenders. And so CTAs need to embrace stocks, and for that reason alone. And then number two, over the years, as I said earlier, we've had to sort of go from a short-term trend following to longer-term trend following. I would say back in the late 90s, the short-term trend following stopped performing very well. So we switched to a longer-term approach. So leaving the turtles with 20 markets and a short-term trend following, we've evolved into long-term trend following, holding periods of 6 months to a year, and then hundreds of markets, always on the search for more and more markets to make the trend following better.
But individual stocks as a whole, they are quite highly correlated. Isn't it a problem that you just bet on single stocks, single companies, but if something bad happens, they are very highly correlated as a whole?
Yes, but no. Yes, I'm glad you threw in there. But if something happens, yes. Now, if something happens, all the stocks are going to go down, or maybe they'll all go up. We've seen periods like this where things happen. But I don't think the stocks are more correlated than currencies. So frequently recently in the currencies and the bonds, we've been long all the bonds or long all the currencies like now. But prior to that, we were short all the currencies and short all the bonds. So those two groups, which make up many parts of CTA's portfolios, they do have a tendency to all be one way. And you get some diversification on the entries and exits and the profit and loss in particular trades. Not all the trades in the bonds, even if you're if you're long them all or short them all at a certain point in time, are going to make the same amount of money. But still, they're all kind of moving in the same direction. And same with the currencies. Commodities are much better. But like in the stocks, that just doesn't happen. We've seen lots of diversification in the stocks over the past few years, with lots of longs, lots of shorts, mostly shorts transition into mostly longs, but always having some shorts and longs on at the same time. Now, your point is a good one. When there is a big crisis, when there's a big sell-off, which we've had this year, all the stocks went down. True. All the stocks went down, but because we were using a trend following approach, we had some shorts on. And so the stocks went down for a few weeks due to the tariffs scare from Trump in the US. And we got out of some stocks. We stayed in some long stocks, and our shorts did well. We came in prior to that with shorts on. And this is another thing that's really helpful is you don't want to have to have this diversification help you out when after these things happen. You want to come into these crises with a balanced portfolio of longs and shorts of currencies, commodities, and stocks and bonds, and not have to scramble to find diversification And so that's why it's so important to trade this stock portfolio. So, because sometimes a sell-off is going to benefit you. You're mostly short, or you're somewhat short and not just 100% long like you might be in indexes more often. And likewise, in that particular period, we were hurt in bonds and currencies, and we were pretty much had the same position in all the bonds and in all the currencies. So sometimes these issues with diversification and being not having as diverse a portfolio as you want, because you're creating this portfolio and the portfolio has these positions that are in gear with the trend, is going to be a problem. And there's nothing you can really do about it except, trade small. That was another a big Richard Dennis idea of trade small, follow the system, and stay alive and live to trade another day. So that's always a possible something that you want to concentrate on. But I'm a big fan of the stocks. They give more diversification than people realize. I'm looking at hundreds of stocks every day, and I see that level of diversification almost all the time, except in big sell-offs, as you mentioned.
Trend following strategies were traditionally only available through hedge funds with high minimums and 220 fee structure. Now we have ETFs like, for example, your TFPN, Trend Following Plus Nothing, or MFUT by Cambria. How significant is this democratization for retail investors?
I think it's great. I think it's fantastic. You're right. Trend following strategies now are available in ETFs and mutual funds. I think that that the general public, the retail investor, is underinvested in trend following. They don't really know too much about it. Like you said, it hasn't been made available. I think but on the other hand, I'm very optimistic because I meet so many people who love trend following, who understand trend following. And I think retail people use trend following, and they are more acceptable of trend following than institutions. Institutions have more political reasons to underinvest in trend. If you lose money in a strategy like trend following, where it's not generally accepted by lots of people, that could be more of a negative than losing money like all your friends are losing just in the stock and bond market. So I think that there is a big opportunity in the future for trend following ETFs and mutual funds to show the general public what they can do. And they'll be talking to people who are more acceptable of this strategy, I feel like. And the fees are much more reasonable. I think one of the problems with some of these funds, ETFs, is that the larger CTAs are coming in and creating these funds, and they're making them really just a few markets, 10 or 20 or 30 markets, and they're not getting the level of diversification that trend following really needs. MFUT has over 120 markets. TFPN has 400 markets. So it really gives the client more of the true trend following experience. I think that the ETFs are a good idea for the retail investor, and they're getting with some of the ETFs, you're getting the full-blown program of hundreds of markets and the true trend following. But there are a few out there that the larger CTAs are coming in with ETFs as well, where they, even though they're trading hundreds of markets in their big hedge funds, they're creating ETFs with 10 or 20 or 30 markets. So it's not quite the same experience, but we're trying to give people the opportunity to invest in a full-blown trend following program with hundreds of markets and a true trend program that's taking small losses and letting profits run. And I think retail investors like trend following. They probably like trend following more than institutional investors. They're underinvested in trend following because they haven't had these opportunities. So I see this as a great opportunity in the future for all of us to really help the portfolios of retail people by giving them this alternative of trend following.
And who should be investing in trend following ETFs versus implementing these strategies themselves? What type of investors fits your ETF offerings best?
Well, I think every portfolio would benefit from a few trend followers in the portfolio. not just one, not just us, but maybe a handful of ETFs or mutual funds that are using some trend following. It's going to be a good diversifier to your stocks and bonds. That's interesting thought about some people do like to trade their own money and experiment with trend following, and it is something that people can pick up and do. And I encourage that, and especially it helps them to understand what I'm doing and maybe have some sympathy for me sometimes when we're losing money, and understand that if you're going to trend follow, if you're going to use these systematic approaches, you need to really focus on the process. Or are you a process person? Can you follow the rules? Are you going to be uptight if you lose money? Because you really need to separate um, your rules that are back tested and they should be confident in, and then performance. Performance can be bad for a while. And so you don't want to get down and discouraged because performance is not what you wanted it to be. You need to congratulate yourself and judge yourself based on following the rules and following the system, even though it may take a while before performance catches up and you're happy with it and seeing what you saw on the back test. So, but I would definitely encourage people to understand trend following, and it may just help them understand the managers that they allocate to. But trend following is fun, and looking at the markets every day, even if it's stocks only, for instance, is still a lot of fun.
For sophisticated investors, is it still that the hedge funds structure remain preferable to ETFs, or maybe there are some advantages hedge funds still offer?
Well, so many of the hedge funds don't have an ETF or a mutual fund that you could invest in. And so they're very sophisticated with high fees. The trend following hedge funds, I think, are a different situation where even if you are not a high net worth person and have the money can afford the minimums for the hedge funds, you can still get a pretty decent trend following investment in an ETF with much lower fees. So I think that probably the CTAs in the future need to gravitate towards creating these products for the retail people with the CTA offerings, and or morph into more of a more complicated strategy with maybe less trend following to compete against the other hedge funds and to justify these higher fees. So the fees in hedge funds are supposed to be worth it because the volatility will be less and the ride and the investment will be smoother, and trend following usually doesn't offer that. So you can, in an ETF or mutual fund with trend following, you can make maybe the same amount of money or similar sums of money as in a hedge fund, but maybe it'll be a little bit more bumpy and a little less smooth. But that's why investors need to educate themselves on what to expect from trend following. It's not easy. It's going to be bumpy. Yeah, kind of like the stock market. Probably not as bad as the stock market that makes about 10% a year, but has infrequent 50+% drawdowns. That's pretty difficult to handle. CTAs probably have a better reward risk ratio than 10% return and 50% drawdown.
All right. You have two ETF offerings, TFPN, I mentioned before, Blueprint Chesapeake Multi-Asset Trend ETF, and another one, MFUT, Canberra Chesapeake Pure Trend ETF. I wanted to ask you about the differences and how should investors choose between them?
The two strategies use the same systematic approach, the same systems and parameters. So the difference is in the markets that they trade. TFPN trades a lot of stocks, and 50% of the portfolio is single stocks, trend following single stocks. And the balance is made up of currencies, commodities, and bonds. So that's for a person who really likes stocks, really wants maximum diversification of 400 markets, and really sees stocks really wants their entire portfolio trend followed. I like to trend follow everything. I don't want to have a buy and hold, a passive. I want to have a trailing stop and a stop loss on every position. I don't want to buy stocks when they're going down or any market when it goes down. And I don't want to try to call the tops and get out near the top. And I want to preserve my capital by taking small losses even on my stocks. We can add so much value to a portfolio by adding a trend following ETF to your portfolio. But what this does, it goes even deeper. It says, I'm going to actually trend follow your stocks and bonds. And so some people that resonates with, and they say, I love it because I love trend following. MFUT is more of a typical managed futures CTA fund with 25% stocks, 25% bonds, 25% currencies, 25% commodities, and still the same trend following, but with just a less of a commitment to long and short equities.
All right. ETFs provide more transparency, I would say, than hedge funds. And I wanted to ask you, how does this transparency maybe impact both investor behavior and also the strategy implementation?
It doesn't really impact our implementation, but I hope it helps with some of the with clients in their ability to every day the client can log into the website and see the positions. And so I would imagine if anybody is downloading my positions and looking at them, they will all they'll see, oh, wow, all of these positions are in line with the trend. So all of the long positions are still trending higher and the short positions are still trending lower. And we'll have some markets that we have no position in, of course, because from our point of view and our system's point of view, there is no trend. So you would think that this would make people feel better. I'm not sure. It's a lot to wade through. It's a lot of markets. Even MFUT with only 120 markets, still, it's a lot to go through. And I think people look at this and say, well, this is a big job, applying trend following to all these hundreds of markets. I'm happy to pay Jerry his small fee to do this for me. But I think really it gets down to the part of educating people. We're going to roll out a new website soon that really puts an emphasis on what is trend following and how to trend follow and how to think about trend following. And you really need to convert people into this way of thinking about the markets, that it is a benefit to have a trailing stop, a stop loss, and always be in gear with the trend. And this is just a mentality that, and to try to find people who really believe this and really think it's a good thing. And so when you have losing periods, you're like, so what? I don't care, because I'm not going to just invest in the stocks or with regardless of what's happening, because people can just as many people get out of trend following at the exact wrong time as get out of stocks when they're down 50 or 60%, because they've had enough, and it's the exact wrong time to do it. If you buy into these strategies of passive longs or trend following, you really need to set up the portfolio in a way that allows you to stick with it and not deviate, because you're inevitably going to change your mind and panic at the wrong time.
Some argue that as trend following becomes more widespread, also including ETFs, because of the ETFs, it might lose some effectiveness. How do you respond?
I mean, it's possible, I suppose. I think it has this eternal mechanism in it that helps with that, because it's so hard to do and it's so counterintuitive and people don't like it. And since a few of the trades that we take make all of the money, these outlier trades, these big trends like cocoa and coffee and gold and Bitcoin, it's so important to handle these trades correctly. And 99% of the trend, even the trend following community, does not hang in there with these trades long term. They get out of the trade before it turns around. Possibly they guessed right and got out the high, but more likely the market keeps going. Some CTAs last year bragged that they were selling cocoa every day in January as cocoa continued to hit new highs. A very anti-trend following thing to do. So you have trend followers who manage the majority of the money allocated to trend following, but they're really not implementing trend following strategies to the degree that you would think. They are getting out of trends before they turn around, using reasons like it's too volatile, it's too correlated, it's too strong. Really blasphemy from a trend following perspective. So there's just not that many people who are really trend following yet. It's too hard. Everyone acknowledges that when cocoa gets too volatile, you should get out of it because it's going to hurt your Sharpe ratio. Almost everyone, not Jerry, not Richard, not Moritz. There's a few of us out there that still let profits run.
How do you evaluate and communicate the results of your trend following ETFs? How do you approach investor questions about their performance, especially when compared to benchmarks like the S&P 500, for example, when the stock market is strong, whereas maybe trend following is struggling at the time?
That's the big question. I think everybody sees the stock market as the most important thing ever in investing. And I like to have this diversification of CTAs or alternative investments, but I don't like it when it underperforms. So trying to convince people that diversification is a good thing, even when your alternative or your trend following isn't working well, is very difficult. I think now is particularly tough period because stocks look so good and trend following looks so bad. So the key is to continue reminding people of that. And I think, frankly, some people just have to go through a period where they do the wrong thing. They get rid of their trend following, stocks crash, they regret that, they realize they made a mistake. So the next time when the stocks crash, they will still keep their trend following. It's just like all of us. We have lessons to be learned in the markets. It took me a long time to learn to put the trades on. The most important thing for a trend follower is not to miss a big trend, which means you have to take all of the trades because they all look the same at the breakout or at the moving average crossover. You can't, if you don't take a trade that's in your system, that's a trend trade, you're inevitably going to miss a big trend. And it's the same for clients. You've got to keep the trend following in your portfolio. And if you don't, you're going to miss the periods where trend works and trend works wonderfully. When I first got in the business for the first 10 or 15 years, trend following was far superior, return-wise and risk-wise, than stocks. Of course, risk-wise, it's long and short, currencies, commodities, stocks, and bonds. And now we're in a period where stocks look to be better trenders. They look to be superior markets, but over the long term, they're not. And they won't always be. And I think there will be a period where the currencies will be the best market for 10 years, or the commodities will be the best market for 10 years. This is just hard to get across to people who are not professional investors, or even people who are professional investors who get swayed by short-term performance.
Yeah, so I wanted to talk about views on passive investing and your market philosophy. And to set the stage for your views on passive investing, what is your overall investment philosophy? We already heard a bit of this, but if you could just say this again. And how do you see the role of passive indexing and active strategies like trend following in a balanced portfolio?
Well, obviously, I think trend following is wonderful. It's trend following plus nothing. What else do you need? Nothing. You have all the markets. We trade more markets than any other alternative, any other strategy. I am a fan of a systematic approach, back tested. So any systematic approach that has a large sample size of trades to look at, that's a robust approach, I'm in favor of that. Trend following is one of those, and it's the easiest probably to implement. I love having a stop loss. I love having I love the idea that it's counterintuitive and I'm in the minority and I'm still long cocoa and it's a hard trade. It's hard to do. I love all these philosophical reasons for wanting to be a trend follower. Diversification is just so important. Traditional value people like Buffett and Munger say, diversification is for losers. It's for people who don't know anything. You have 4 or 5 good ideas, put all of your money in that. And I think that's a reasonable philosophy for people who don't use a systematic trend following. All the trend following trades have the same expectation. You'll make the same amount of money over time on all of your trend following trades. No trade is superior. You're using this approach, these numbers and these systems and rules over all of the markets. You're using the same rules.
I wanted to ask you about Jack Bogle because he made a huge revolution in investing with his low-cost index funds. I wanted to ask you, what's your assessment of his contribution and where do you see limits to the index fund approach?
I think it's a great thing. I think if you want to just take position in the stock market. This has saved investors billions of dollars, small investors billions of dollars. It just so happens equally as important as that revolution, Bogle revolution, was the fact that the indexes have done so well and they continue to do well. I don't think any index or any approach like that is going to have that same love and affection from clients if it's not performing well. And so it does. It's another way of capturing trends, because in an index approach like that, only a few of the stocks, just like in trend following, 4 or 5% of the stocks are going to be responsible for all of the profit. Everything else is not going to contribute at all, hardly. But in a trend following way, if you trend follow those 500 stocks in the S&P, all of the stocks, many of the stocks would contribute, and many would have long-term trends. So trend following takes that portfolio and really makes all the stocks, or almost all the stocks, contribute to the profit, and getting big trends out of all of the stocks over time, over a long period of time. Almost everything in that index will trend follow. So it really is a different approach, and it really is a good diversifier with trend following. I just think maybe 50-50 is a better idea than 90% stocks and 10% trend following. So I think, in some ways, hopefully we can do the same thing with our approach. It's, once again, the S&P is math. It's a system, and trend following is a system. So that's our goal too, is to bring another type of system with more diversification, a better system that takes small losses and lets profits run, and has some shorts. It too, with low fees, will usher in an era where people will have lots of investments in trend following and passive as well. It's a great complement to each other.
All right. So it's not like you're dogmatic, just saying 100% only trend following and nothing. Of course, maybe you are dogmatic in your own portfolio, but in general, you could recommend other, especially retail investors, to have room for both approaches, for trend following and for the index funds.
That's right. I mean, there's some psychological reasons that people are just not going to be as comfortable. You want to stick with your approach. It's a good approach. You've tested it, and it's worked. And so you just need to stick with it and not abandon it. And so people are just going to have an easier time doing that in a passive approach. Young people have come up to me. I'm trend following plus nothing. I have all of my net worth in trend following. I think it's great. It's maximally diversified. It's maximum risk control with the stop losses and the trailing stops. But young people will say to me, okay, what should I do with my portfolio? And I'm like, oh gosh, don't ask me that question. I can't say 100% trend following. It's just not right. Because you have to educate yourself, understand what you can handle, what you're comfortable with. For some people, it's mostly trend following. For other people, it's mostly stocks. But just understand it's mathematical approaches that have been vetted, that have worked over time. And the whole key is based upon your personality and your risk tolerance, and how much you're going to have FOMO, and how much you're going to regret making less money than your neighbors and your friends, then decide how to set up your portfolio so you can leave it alone and let the numbers work for you over time.
How does trend following perform when traditional stock bond portfolios struggle? And what diversification value does this offer, having some extra addition in the form of trend following here?
Well, historically, trend following has done well sometimes when the stocks sell off for many reasons. One would be they're short stocks, or they're going to get short stocks pretty soon. That's always helpful. And because the trend has changed, or other markets are doing well, currencies and commodities or bonds. Like I said, in 2022, trend following CTAs were short stocks and bonds. Great year, fantastic year, in a year where stocks and bonds passively both lost money because the trend simply had changed. And passive does not, the passive rules don't say when something happens, get out. No, it says stay in, try to buy more, or get short. No, it doesn't say get short. It says stay in, try to buy more. Sometimes it's due to the short stocks, and sometimes it's due to other markets. But I think trend following can do well when stocks do well as well, because we'll be long stocks And there could be good things going on in the world fundamentally that are driving commodity prices or interest rates and currencies into trends as well. Maybe not all being long, maybe some shorts as well, but trend following can do well at any time when there's trends. And I think it's very important to realize that trend following does well, especially when things happen that we've never seen before. So to some degree, we can't really rely upon how is trend following done historically, because a lot of the performance is due to periods and fundamentals where we've just never experienced them before. And trend following doesn't ask those questions. What do I do when interest rates start going to zero? What do I do when COVID hits? What do I do when there's a financial crisis? Trend following says, where's the trend? I'll get in gear with the trend. Is it time to go long, short? And which markets in the portfolio are going to benefit from those trends? So having lots of markets, lots of options, and only paying attention to the trends when everyone else is trying to make sense of this crazy world we live in is one of the big benefits of a trend following strategy.
How have changes in market structure like algorithms, AI, ETF proliferation, and maybe central bank policies affected trend following in your view?
Well, I definitely think that algorithms and computers definitely have impacted trend following, especially the short-term trend following, which I don't think struggles to work these days. So that's been going on for a long time in my opinion, since the late 90s. Trend followers needed to expand their look-back period and their holding period and just frankly sit with more volatility and drawdown. We're going to have trends. The trends can last a year or two or three, but it's just going to be bumpier and just be more of a longer-term trend follower. AI, I don't think has really impacted us too much yet. AI is a different strategy, a different way of looking at the markets, predicting what's going to happen over the short term, where trend following is looking at 1 to 2 year trends. But trend following has always been impacted by something. It's always been classified as probably not working any longer. And now is that period we're in now. But I'm sure we'll see some trends and we'll have some massive trends like we saw in 2021 and 22. Those were 3 of my best years ever. And it was unprecedented market moves, especially in interest rates in 22.
You've added Bitcoin, as you mentioned before, Bitcoin futures to your trading universe. And I wanted to ask you, how do you evaluate new asset classes for trend following?
Well, I think the best way to evaluate them is two ways. One is obviously liquidity. Is it liquid? Can we trade it? Can we get in and out without causing too much slippage, and the cost of trading it is moderate? And then number 2, does it add diversification? Is it something that's going to make the portfolio more stable? Now, one of the problems with that for trend followers is we trade a lot of markets. And I've already said we trade all the bond markets, for instance. And I also said, well, they're frequently all correlated. So which is it? Is it diverse? It doesn't sound like you're trading all these bond markets, but you're not really picking up a lot of diversification if they're all can be correlated, which is true. So we trade a lot of markets, but our primary focus on trading these markets is hunting the outlier trade. So even if there's a high correlation in a sector in one particular sector, it doesn't mean that some of the markets in that sector won't have a bigger move than the other ones. Like in 2020 in the commodities, we traded all the commodities. They pretty much all went up, but there was a couple of them that were bigger trades than the others. So we're not really trying to fine tune the portfolio to get the perfect portfolio based upon correlation and diversification, which we do have a lot of that, but we're just trying to add more markets that will give us more opportunity to pick up outlier trades. And so, because even when all the currencies move, the yen was the best, by far the best. So, but yet it was still somewhat correlated to the other currencies. So this is something that you're going to run into a lot. Fine tune the portfolio to a fewer markets, because it's not worth adding more markets due to correlation. It misses the fact that you're going to miss some really large trends. And within a highly correlated sector, mega trades and just a handful of those markets can pop out and you'll miss them if you don't have them.
How do you think about geopolitical events? You mentioned before that we are living in a crazy times. So I wanted to ask you about such events and their impact on your strategies. And do you make any adjustments here?
That's a good question, a timely question, because we had a really bad impact back early this year with the tariffs, where everything went against us over a short period of time. Very frustrating for clients, very frustrating for the manager, the trend follower. It's really just a question of making sure that we get whipsawed. So we take the small loss, but then the market reverses and goes right back to where it was. And so we have to get back into the long position, possibly having just gotten out. And we'd have been a lot better if we'd have been passive and done nothing. So I don't think it's and if we have too many of those, it's going to be really uncomfortable. But these things have a tendency to happen. They probably actually keep people away from wanting to be trend followers. I keep mentioning that idea, and probably set the stage for good markets in the future. So I think the key is, as always, to expect the worst, expect bad things like this to happen, because then you'll be more sober in deciding how large you're going to trade. These futures markets and professional traders and trend followers are going to use leverage and really be able to decide how much risk they want to take on. It's just not having $1 million and buying $1 million worth of stocks, and you're just going to be hostage to whatever the stocks do. We can fine tune that risk level and that risk budget. And traders have a tendency to overestimate how much risk they're willing to live with. So we're often reminded, hey, check yourself, check your amount of risk. Are you taking on too much risk that's going to make it hard for you to recover from the drawdown, and also stick with your system? Whenever I've gotten in trouble when I was younger, it was because I was trading too large, and I had to abandon my system and start trading smaller, or even worse, start doing non-system trades, because I had traded too large and I was losing too much money. So you want to stay away from that.
All right. What do you see the future of active management, especially as passive strategies are dominating right now?
Well, I think the future of active management is going to be people understanding the value of active management. And I think the fees will continue to go lower, and especially from hedge funds. There will be a lot of hedge funds that will have to abandon 2 and 20 or performance fees in general, because there will be so many people like us taking these wonderfully great strategies and putting them into an ETF wrapper with a low management fee. So I think it's just going to get, like most things in our society, it gets better for the consumer, and it gets cheaper for the consumer. And I think, but first of all, people need to uncover the benefits of a systematic strategy. So it's active, but it is still based upon a algorithm, and not 100% passive. And I think that's just going to encompass algorithms that force the portfolio to go with the trend, take small losses, and preserve capital. Nothing more important than preserving capital. And sometimes you can't preserve capital only with diversification, because everything is going against you. You have to put in there some active take losses and reduce the losing positions.
What have been your biggest mistakes or key learning moments in your career, and how have they influenced your approach?
That's easy. Like I said earlier, missing trades, missing big trends, and you don't know when you're going to get a big trend. You have to assume that all of the trades could potentially be a big trend. Trend followers never miss the big trends. It's easy not to miss it, but that's why we have 60% losing trades, because we're always taking a trade that doesn't turn out to be a big trend. It doesn't even turn out to be a winning trade. So I think the first turtle trade, the first big turtle trade, was February 1984 heating oil, and it doubled in price, let's say, and probably half the turtles didn't even take the trade. So here we are leaving the turtle class 2 weeks ago, being told don't miss a big trade, and half of us missed it just because we didn't take the trade. What were we thinking? So we had all this training, all this backup from Richard Dennis, and I feel bad for retail traders and young traders who are missing trades, not missing trends. They took 2 losses in a row, didn't want to take the third loss, so they didn't get in. And that's the time the trade took off and did really well. And I'm acting like I'm this expert, but I had the same thing happen to me. So it just takes practice and it just takes time to realize that there is something worse than a small loss, and that's missing a big trend. So you can't miss these big trends. And I've missed mine, getting out too quickly. Everybody does it, trend follower or not. You always get out too quickly because we're so afraid of not getting out near the high. And we think the high is in. We think it's gone so far. Can it go any further? Usually it doesn't. But sometimes when it does, you leave a lot of money on the table and you don't make nearly the amount of money. And it's just something that everybody wants to avoid, which is looking stupid, looking silly, and hanging on to a trade too long. It's not too long because you've done the back test. You have your rule. It works. You're going to make a lot of money with these rules. So just follow the rule. You're not staying too long. You're staying the right amount of time because you're basing your philosophy and you're committed to following your rules. And your rules are good and you need to follow them all the time, every time. Don't guess. No matter what people say, people try to convince you. And three, I think, is over trading, just trading too large, taking too much risk. Don't risk 1 or 2 or 3 or 4 or 5% per trade. Risk 1/4% per trade. If the stop loss gets hit, then you'll lose 1/4%, 1/10%. Whatever. Start small. You're young. You're going to make lots of mistakes. Trade small. Uh, You're going to pay this tuition to the market. You're learning tuition. Don't make it so large. And like I said, trading large and following the system are two things that compete against each other. You're going to have to trade small at some point. If you trade too large, you're going to have to cut your positions in half, trade half speed for a while, and it could be at the exact wrong time. And so it really plays havoc mentally with being able to take the next trade. I can't afford to do the next trade because I've lost so much money already. So you need to do whatever it takes to be able to do the next trade and follow that system. And usually the reason you can't is because you've been too risky. And
All
Rich told
right.
me that 30, 40 years ago, and it hasn't changed. Isn't that sad? We knew going into our career the mistakes that we would make, and yet we still made them.
Beyond returns, how do you measure success for yourself and your investors?
Well, it's going to be returns over the long period, but not over 1 year or 2 year or even 5 years. So look at your 10-year return. But ultimately, you want to be a person who looks at process and say to yourself, write your trades down. One of the things that Turtles did for the first few months of trading was to keep a journal of all their trades. Write them down. What trade did you do? What trade? Why did you do it? What rule were you following? And then, of course, you may have to write down the trades you didn't take. Why? What were you thinking? Why did you take them? So these are all very important, all very, very important things to keep in mind.
Okay, we are slowly reaching to the end, but I have some closing thoughts at the end. How would you like to be remembered in the investment industry, and what legacy maybe do you hope to leave?
Oh, well, it's a good question. I definitely think that trend following needs a head cheerleader, and that's probably me. And so I want to, and there's just a few people we only need a few people to pick up the banner and see the virtues of classic trend following, letting profits run, taking small losses, maximum diversification, trend following stocks, and trend following plus nothing. Because it will shine and it will outperform all other strategies over the long term. And but I think that's another part that's really important too, is to set it up to where it will outperform. Not just the philosophy is great and it's available to so many people. And it's really the way that so many people can protect their portfolio and profit in the markets. That's why it's so appealing to everybody or to lots of people, because it is the strategy that that can guarantee above average returns and below average risk. But it needs to perform. And so we need to continue to improve it and add diversification to it and do all we can and create product that puts it in its best light, that creates a track record that is going to be worthy and be correct. I'm coming up with these indexes, trend following indexes that will disclose the rules. Everything will be transparent. And hopefully we'll have this diversified trend following index with the trend following rules and the markets. So this thing can live on forever as something that people can understand and learn from and invest in and be in control of their portfolio and protect it. It's dangerous to miss trends and not take small losses and not be diversified. And people don't see that now. They're living stocks will probably come back after the next 50, 60% drawdown. Probably, maybe.
Hopefully.
Yes, of course.
Which books, resources, or learning paths do you recommend for those interested in understanding trend following better?
I like interviews of managers, interviews of CTAs. There's podcasts, so many great podcasts, so many great interviews. Traders, smart traders and hedge fund guys, they talk too much. They tell too many secrets. I've told too many secrets today. But you'll get this encouragement and this underlying philosophy of paying attention to price, diversifying, protecting your capital, trend. Everyone has it a little bit different, but it's hard to, I would think it'd be hard to survive on Wall Street for long periods of time without those characteristics. I like the Market Wizards books. They're a little old, but still a lot of good philosophy there. Marty Zweig books, great books. My favorite person today is Richard Brennan from Australia. He's the best trend follower out there, the smartest trend follower out there. He has a website. Aussie Turtles is a podcast. And Rich is just a genius on Twitter, writing books. So that's the best resource to learn. He's pretty smart. He's pretty technical. He's great in math, but still it's approachable. And if you want to take a deep, deep dive, I think people underestimate the complexity and the uptrend following, not the complexity, but the deepness of it, philosophical deepness and math of it. And I'm always trying to remind people of that on Twitter as well. My Twitter account is a good resource. I'm scouring the earth for podcasts and articles and things that continue to preach the benefits of trend.
Jerry, thank you for a fantastic conversation. Your insights and stories made this trend following, I would say, as lively as a turtle race. It's been really a pleasure having you, and I'm sure our listeners are now ready to follow a few new trends themselves. And to everyone tuning in, keep exploring, and remember, at ETFatlas, we help you find your way. Thanks for listening, and don't forget to subscribe. Thank you, Jerry.
Thank you, Jack. It's been great. I really enjoyed it.